We're moving pretty quickly through the last half of the course, and I wanted to kind of start bringing all of these elements together. So the last piece we're going to talk about here in the capital structure section is distribution of retained earnings, dividend stock repurchases. Essentially, when you buy a company or when you buy stock in a company, you expect that you're going to be able to get some cash back out of it. Now, that's going to be in the form of either capital gains or in the form of distributed earnings known as dividends. And so we're going to talk a little bit about each one of those as we dig in here. And you're going to see, again, these common themes or common principles of finance continue to hold as we move through and look at each element of the capital stack, including dividends and stock repurchases. So dividends are payments made to stockholders from earnings, whether those earnings were generated in the current period or previous period. So they come out of retained earnings or current earnings. And dividends affect the capital structure. Retained earnings increases common equity. So going back to your accounting principles, retained earnings increase common equity. Distributions of retained earnings decrease common equity. And so the dividends come out of retained earnings, and it'll either reduce the amount that goes into retained earnings, decrease retained earnings. And then financing with retained earnings is cheaper than issuing new common equity. Remember, we took a look at, when we looked at weighted average cost of capital, we looked at that financing with retained earnings piece, and then we looked at the amount with flotation costs. We saw flotation costs could be significant and could increase the weighted average cost of capital significantly as well. And so financing with retained earnings is going to be cheaper than issuing new common equity because of the presence of flotation costs. There's an argument that talks about the dividend irrelevance theory, which states that a firm's dividend policy has no effect upon either its value or cost of capital, and investors will value dividends and capital gains equally. Now, there's a few things around that might not hold true. One is if the tax treatment for dividends and capital gains are different, and how easily the investor can reinvest those dividends into equally yielding assets. The dividend relevance theory, on the other hand, says firm's value is affected by its dividend policy, and the optimal dividend policy is the one that maximizes the firm's value. And that tends to be the one that I personally go with, and I think the market tends to agree. And the optimal dividend policy is the one that strikes a balance between current dividends, so paying out cash to current stockholders, and future growth that maximizes the firm's stock price, given the factors that we looked at a couple chapters ago, where you're looking at how do I optimize the weighted average cost of capital relative to the investment opportunities that I have in the firm with projects and such. And so you're going to be looking at where those points cross over. Investors will look at dividends, and there's going to be information content that they will read into a dividend policy. So dividends essentially there's a signaling hypothesis which says that changes in dividends are reflected by investors as a management indication or the board's indication as to whether the future prospects are bright or not. And so if people increase dividends, it tends to be a show of support. If it decreases in dividends, tend to be viewed negatively by investors. And there's a clientele effect with dividend policy, which is folks who are looking for constant immediate earnings. So they've called them widows and orphan stocks. And they pay routine dividends every period, every quarter. And those dividends rarely go down. They generally go up over time. And they're used for current income, thus the widows and orphans. And there's investors who like that type of dividend policy where they need the cash, they're relying on the cash, so they've invested a significant amount of money into a stock and they want the cash out periodically to live off of. Others like capital gains because those capital gains have a different tax treatment and the payment of those taxes are deferred into future periods. And so you have some stocks that pay no dividend at all currently, and instead that money's reinvested. And so that has a different clientele. So stocks tend to have a clientele effect and the dividend policy will impact what type of investors will invest in those stocks. There's also a free cash flow hypothesis. So you can see the dividend policy is a well-researched element of corporate governance. And the free cash flow hypothesis says that all else being equal, firms that pay dividends from cash flows that can't be reinvested in positive net present value projects. So again, when you take a look at that Unilate example from a couple chapters ago, if nothing goes above the weighted average cost of capital line, so there's no projects available, then the cash should be paid out in the form of a dividend, and the investor should be able to then reinvest it as they see fit. And the hypothesis says that in all other things being equal, firms that distribute those cash flows are valued more than firms that retain those cash flows, because those cash flows are being retained but not invested at something higher than weighted average cost of capital. In practice, there's a few methodologies that are used by corporations in how they actually pay out dividends and declare them. So there's a residual dividend policy, and that's a policy where the dividend payment equals the actual earnings minus the amounts needed to hit the optimal capital budget. So this is essentially, when you look at the Unilate type model that we did prior, there's a policy where they say, okay, we're just going to essentially pay this amount out, and that amount that's being paid out is being driven by what's available on an optimal capital budget, and anything in excess of that's being distributed. There's a stable, predictable dividend policy, which says, annual dividend payment remains constant or increases at a constant rate, couple, 50 cents a year, 10 cents a quarter. And that annual dividend is fairly predictable, and it normally takes a significant impact to the company's operations on the downside, predominantly, in order for that to be impacted. There's a constant payout ratio methodology, which is the same percentage of earnings. So 40% of any earnings are paid out in every given year. So you'll see some of that go up and down. This is also going to be the case with some special types of stocks, like real estate investment trusts, where they have special tax treatment, but only if they pay out at least 95% of their earnings. And so as a result, as earnings go up and down, the dividend will go up and down, but it's at a constant percentage. And then you've got a low regular dividend plus extras. And a low regular dividend is paid every year, so they may pay 10 cents a quarter, and then make a special dividend at the end of a year when a firm has a particularly good year. And we've seen some of that with companies like Microsoft, where they didn't pay dividends, or they pay very low dividends, and then all of a sudden they'll pay a $20 a share dividend to the owners because they've got excess cash. So here's a dividend, in practice example. You can see that net income in years 1, 2, 3, and 4 goes up and down. So net income is pretty volatile. The capital budget is also fairly volatile, but it's reasonably consistent, around $300,000 a year. You can see the number of shares outstanding, 250,000 shares. Payout ratio at 60%. So this is going to be a constant payout ratio. So a low regular dividend in this particular case is going to be paid out, 75 cents. And then if there's extra above $400,000, they pay out 40% in this particular case. So this would be a low regular dividend plus an extra payout. So let's take a look. Number of shares, 250,000. We have net income of 500,000 year 1, 200,000 year 2, 800,000 year 3, and 150,000 year 4. So we subtract out the capital budget, and we say, okay, what's the capital budget? 300,000, 350,000, 200,000, 140,000. That's coming off of this data here. You can see that. And so the total dividend in this particular case is going to be $200,000. So you had 500,000 minus 300,000 is 200,000. And so you've got $200,000 available, and the dividend per share is going to be 80 cents, which is 250,000 divided by 200,000. Here you had nothing left, so 0 dividends were paid. Here you had $600,000 left, 800,000 minus 200,000 capital budget, so $1.39 was paid. And in year 4, you had 10,000, and so you had a low dividend of 75 cents paid. In this particular case, where you've got a stable dividend policy with 250,000 shares, the dividend just stays the same at $1 per share for $250,000. Doesn't matter what the capital budget was, we're paying $1 per share. If you've got a constant payout ratio where we talked about, they said, okay, we'll pay out 60% of the net income. We've got a payout ratio at 60 cents on the dollar. So we had 500,000 of earnings in year 1. That gives us a dividend of 300,000. So we just divide that into the 250, get $1.20 per share, 72 cents a share, $1.92 per share, 36 cents per share in year 4. And you can see how that's calculated here. If you have a low regular dividend plus extras, you can see we essentially have the net income, the low regular dividend of 75 cents, which came off the original sheet. You've got an extra dividend above $400,000, 40% of the amount over $400,000. So in this particular case, 40% of 100,000. So you're going to pay out 227,500 here. So 91 cents, 75 cents, $1.39, because you had a very, very good year this year. We had an additional $400,000 of interest or of earnings, and you paid out 40% of that. And then here you didn't meet the threshold above 400,000, so you pay out that base $75,000 or 75 cents per share. Again, when you look at the dividend policy, the residual dividend policy essentially paid out, a relatively small amount. It was very volatile. The stable dividend policy paid out the $1 a share every year, and then the constant payout ratio was also somewhat volatile. This gives the lowest amount. The stable dividend policy gives the lowest amount of variability, the least amount of risk, the perception of the least amount of risk to the investor. However, as you are now aware, your highest risk may very well be this when it comes to the position of the firm, because it's using cash that would otherwise be available for investment in projects to then pay out a dividend to the shareholders. There's a few elements of dividends that are definitional in nature, and so we'll talk about these. You'll see these in investment things all the time. You've got the dividend declaration date is the date on which a firm's board of directors issues a statement declaring a dividend. So in order for a company to issue a dividend, they need to declare it. And so there's a declaration date. That's the date that they say on A, and then that becomes a holder of record date. So all holders of record of stock X as of this date will receive a dividend of 75 cents per share. That as of this date is a holder of record date, the date on which the company opens the ownership books to determine who receives the next dividend payment. You've got next dividend date is a date on which the right to the next dividend no longer accompanies a stock. So it's normally 2 business days prior to the holder of record date. So if a company says, if Unilate says we're going to pay 75 cents a share on April 1st of 2020, and to shareholders of record as of April 1st, 2020, the ex-dividend date is going to be 2 days prior to that, so the 30th of March. And the reason for that is stocks trade in the stock market, and when people know, if they declared that dividend on February 1st, they know that, hey, if I hold this stock, I'm going to, on April 1st, as a holder of record, then I'm going to be able to get the shares associated with that stock. Well, it takes a couple days for those transactions to flow through and get posted to the company's books. And so what ends up happening is the stock exchange says, if you hold this stock as of the 30th, so 2 days prior to the 1st, we're going to assume that you get the dividend. After that date, if you buy it on the 31st, the stock trades ex-dividend, which means the person who sold the stock on the 31st gets the dividend, not the person that bought the stock on the 31st, even though the dividend's date, the hold date is actually on the 1st of April. I realize it's a little bit confusing, but essentially the ex-dividend date, if you own the stock on the ex-dividend date, you get the dividend. If you buy the stock after the ex-dividend date, you don't get the dividend, even if it's before the date on which the company says, as of this date, shareholders will receive the dividend. The payment date is the date on which the dividend is actually paid. So they may declare the dividend on February 1st. The ex-dividend date may be March 30th. The hold date, the as of date may be April 1st, and the dividend may be paid on April 30th. So those are all different dates that you need to be aware of if you're buying or selling stock. Some companies have dividend reinvestment plans. So these are plans that enable stockholders to automatically reinvest the dividends received from the company back into the stock of the paying firm. And firms either repurchase shares on the open market to fulfill that requirement, or they issue new shares to fill the DRIP, the dividend reinvestment plan. There's almost no brokerage fees associated with dividend reinvestment plans, and companies can utilize that to essentially retain cash. So a lot of utilities have dividend reinvestment plans. So you could say, instead of getting my $20 dividend check, please reinvest that into utility company stock, and the company will do that for you and then issue you additional shares, which then begin to compound. There's a few factors that influence dividend policy, and you've seen some of this as we've discussed the various elements as we look at capital budgeting and such. So there's a few constraints on dividend payments, debt contract restrictions. So you essentially will have things called covenants. We talked about this earlier in the course, where essentially you need to have a certain amount of retained earnings, or you need to have a certain amount of cash flow, or you need to have some other element retained by the business, or certain performance by the business before you can pay dividends. And that's because you have bank debt or bonds that are outstanding, which come above the dividend or come above capital, common stock on the capital stack. And so as a result, that debt will have restrictions. And if you're not current on that debt, or if you're not meeting certain performance requirements, you're going to be prohibited from paying common stock. Additionally, or common stock dividends. Additionally, you can't exceed retained earnings. So if your retained earnings on the books is negative, by law, you can't issue common stock, you can't pay a dividend. Cash availability, if you don't have cash, you can't pay the dividend. And IRS restrictions on improperly accumulated retained earnings. So there's a rule which essentially, because dividends are taxed currently, so if you are paid a dividend, you have to pay tax on it. The investor needs to pay tax on it. So one thing, as I just mentioned a few minutes ago, one of the things that drives dividend policy is some folks say, hey, I want to defer my taxes to a future period, so please reinvest my dividends. Please keep my dividends in the business, don't declare them, and reinvest those in other opportunities. Well, people got smart to this, especially in private companies, and they wouldn't issue dividends. They would just continue to hold the cash in the business, and they would hold it for years and years and years and years and years and pay it out later. And the IRS has said, look, you can't improperly accumulate retained earnings. You can't hold a bunch of cash in the business. You've got to have legitimate investment opportunities, and you can have some for emergencies, but you can't just sit on a wad of cash. You have to distribute it out to shareholders, because we want to be able to tax that dividend. And so there's IRS restrictions on improperly accumulated retained earnings, and retained earnings need to be regularly paid out in the form of dividends if there's no investment opportunity. which gets us to investment opportunities. If there's good capital budgeting projects and they're available for the company to invest in, the company's going to want to make those investments and improve the return to the investors. And so as a result, if you've got good capital budgeting projects, that'll impact dividend policy. That's the argument for a Google or for an Amazon for not declaring dividends and holding cash, is they feel like they've got a lot of opportunities for high ROI, return on investment, high IRR projects. And so as a result, they hold the cash in, they don't pay dividends. There may be alternative sources of capital as well. So there may be opportunities for them to be able to go borrow additional money. And so as a result, they don't, or issue preferred stock. So they may not want to pay dividends out. They may want to use that cash instead to pay additional preferred stock and not dilute, which is in the next section, the shares. So they may have a dividend policy where they say, instead of having a dividend, we're going to buy stock on the open market. And what that does is concentrate. So if you had an additional $1 million, and we're going to walk through some examples, if we have an additional $1 million, we may want to buy those shares on the open market, and then utilize, and then that becomes concentrative to earnings and ownership. And again, dividend policy is going to affect the expected or the required return on stock. If you recall, D hat sub R, which is the expected dividend at the end of period one, is the driver for the dividend growth model. And so as a result, dividend policy will have an impact on required rate of return for that stock. If you're not paying it out in dividends, you need to be showing growth. So stock dividends and stock splits are two sides of a very similar coin. Both stock dividends and stock splits increase the number of shares outstanding. They divide the same pie into a number of pieces. Unless the stock dividend or stock split conveys information or is accompanied by another event like high dividends or a merger or something along those lines, the per share stock price adjusts so it keeps each investor's wealth unchanged. So essentially, if you had a company and it was $100,000 worth of stock, and you had 10,000 shares, and each share was worth $10, and you did a 2-for-1 stock split, you still have $100,000 worth of stock. You now have 20,000 shares, and each share is worth $5. And we'll walk through that. Stock splits and stock dividends might help a firm maintain its stock price in an optimal price range, which generally is somewhere, again, historically has been somewhere between $10 and $60 to $70 per share. Once you get much above that, there used to be a requirement. You generally had to buy shares in lots of 100, and so, or your commissions were significantly higher. So firms like to keep their share prices down under 100, so that the round lot, the price for 100 shares would be under $10,000. And once stocks start getting into the single digits, there's a psychological effect that people think, oh, this is really cheap, or the company's not doing well, so we want to keep our stock between $10 and kind of pushing up to $100. However, it doesn't really have any impact on shareholder wealth. So the company's still the company. You just took the number of shares and increased them or decreased them, but you're taking that same pie and dividing it by a different number. That's all. So with stock split, it's an action to take, change the stock price per share. And firms believe, like I just mentioned, that a stock has an optimal price range in which their stock should trade. If it gets too high, the firm will execute a stock split. So if a price of a stock gets up above 100, let's say, and they go, hey, our optimal trading range is below 100, they may go, we're going to issue a 2-for-1 stock split, which then doubles the number of shares outstanding, but will reduce the price from 100 to 50. And if a stock is trading down at $3 or $4 a share, and we go, hey, we really want to be able to get this back up to a price that people think the company's worth something and not in trouble, we may do a reverse stock split. So a 1 for 10, where if it's trading at $30 or at $3 a share, they do a 1 for 10 reverse split, and now it's trading at $30 a share. But if you had 100 shares before, you have 10 shares now. When a regular stock split gets initiated, generally the price of stock actually settles above, because people take this as a information signal from management that the company is going to continue to go up, and so as a result, we're taking the stock price down and putting it in its optimal price range, which then people go, oh, they think the stock price is going to continue to go up, so they needed to get it down into the right trading range, so we're going to buy. And so what ends up happening is, there's the stock price might go from 100 to 50, but then it trades up to 55 or 56 because people view that as a positive signal. The stock dividend is often paid when the company doesn't pay cash. So they say we're going to pay stock dividends in the form of stock, or we're going to pay dividends in the form of stock rather than cash. Stock dividends are like stock splits. It doesn't do a darn thing with respect to the firm's value. There's 10% stock dividend. You have 100 shares. The next day you have 110 shares, but the value of the firm didn't change. And so what ends up happening is the stock price might have been $50 a share prior to the stock dividend being issued. It then turns into 45 shares. So you had 500 shares at 100. Now you've got 110 shares at 45, and you're basically at the same economic place. They might use a stock dividend to keep the stock price within a particular range, but in general, that's not why it's used. The book will talk about that a little bit, but it's generally used when you're wanting to have people, again, investors like to get things, and they view stock dividends as having value, even though, again, you're now a finance student, so they really don't have much value, but they provide a signal, a psychological signal that, hey, we expect the company to be doing well, so we're going to issue you a little bit more stock. People go, hey, I used to have 100, now I got 110, see, I've got more, isn't this great? Really nothing economically changed, but it sent a signal, and it psychologically made the shareholders happier, which then might cause the stock price to rise, and the full impact of the stock dividend isn't felt. Essentially, you do get a small rise in the price, and therefore a small rise in the actual value. So let's look at the balance sheet effects of a 2-for-1 stock split. If a firm initiates a 2-for-1 stock split, it issues 2 new shares in exchange for each old share. So what happens essentially before the split, you had 50,000 shares at $2 par, so you had $100,000 par value. You had an additional paid-in capital, APIC, of $200,000, retained earnings of $300,000. So you had $600,000 worth of common equity. Now we issue a stock split. And so what ends up happening? Well, we had 50,000 shares. Now we have 100,000 shares. But look what happened. Par value went from 2 to 1. So common stock at par is still 100,000. Additional paid-in capital, APIC, is still 200,000. Retained earnings is 300,000. So our total stockholders' equity is 600,000. Nothing happened. Except we went from 50,000 shares to 100,000 shares, and par value dropped by the same amount. So let's look at the balance sheet effects of a 10% stock dividend. Firm pays a 10% stock dividend. Each stockholder receives 10% more shares. Therefore, before the dividend and after the dividend, the balance sheets would be, and again, you see that there's a difference here if it's a stock dividend versus a stock split, but in general, you end up at the same answer. So common stock at par, 50,000 shares at $2 par, you have $100,000 par value. An APIC is 200,000, retained earnings 300,000. So we start at the same place. We issue a 10% stock dividend. Now we have 55,000 shares. The par value does not change in a stock dividend. In a stock split, it changes. In a stock dividend, it doesn't. So we have 110,000 in stock here in par value. We had 50,000 shares. We issued an additional 5,000 shares. So that 5,000 shares at essentially the APIC amount, you now increase this by another $90,000, so it's $100,000 in total, because that was what the stock price is trading at. So you say, okay, if the stock price is trading at 20, I've got $10,000 of increased par value. I've got an additional $90,000 worth of additional paid-in capital, because that's the difference between the increased par value and the market price. But what ended up happening? Well, I just took that out of retained earnings. So this went down by the $100,000 attributable to the $20 per share. 10,000 went here, 90,000 went here. That 100,000 came out of retained earnings, but our total common stockholders' equity didn't change. So it became a book entry here. Shares went from 50 to 55. Everything else kind of slid up from retained earnings to APIC and to common stock at par, because your par value went up, but nothing else changes. And this just shows what I just walked through formulaically. You can see that the amounts are shifted in the equity section of the balance sheet, and it's based upon the price of the stock at that date. The price effect of a stock split and stock dividend, essentially, it increases the number of outstanding shares, it decreases the stock price. Based upon what you just saw, you recognize the stock dividends create no economic value on their own. So nothing happens to the economic value of the firm. You just have reshuffled the shareholders' equity or stockholders' equity section of the balance sheet. However, there's psychological effects. So the price of the stock might be impacted by the change. So if investors view it as a signal that cash dividends are going to increase, the price is going to increase above the relative price associated with the stock split. And if future expectations don't pan out, the price will settle back down to where the economic change is equal to zero. So they're going to take it as a signal, but if the signal doesn't pan out, then the stock price is going to settle back down again. So there is no panacea with respect to a stock dividend or a stock split. You better be backing that up with performance. Stock repurchases, I touched on this when we were talking about retained earnings. Stock repurchases, at times, firms will repurchase shares of their stock rather than paying dividends. They may have excess cash and they've got a choice. Do I buy stock on the open market, or do I pay dividends? They also may do a stock repurchase to fill the requirements of a DRIP, of a dividend reinvestment plan. So they're going to use it to distribute excess funds to shareholders. It adjusts the firm's capital structure. Essentially, it reduces the amount of paid-in capital. It acquires shares needed to fund employee options or compensation or a DRIP, and it may also protect against takeover attempt, because you're buying open shares, and that concentrates the voting power of the firm. There's some advantages to stock repurchases. A company uses stock repurchases to distribute excess cash flow without increasing the amount of the regular dividend. They buy the stock on the open market. The person who sells the stock has a capital gain or loss, and the company puts it in treasury stock, and it becomes a contra equity account. And a repurchase is an effective method to immediately change firm's capital structure when a proportion of equity is substantially higher than the target capital structure. So we talked about the target capital structure and weighted average cost of capital, and said, hey, some firms will hold on to additional cash because they want to signal that there's other investment opportunities, or they expect other investment opportunities. When that doesn't necessarily pan out, and they want to go and make a distribution of that excess cash and get their capital structure into more of an optimal alignment and essentially increase the debt ratio or preferred stock ratio, or both, there's two ways they can do that. They can add additional debt and preferred stock and take the cash from that additional debt and preferred stock, and then issue a dividend to the common shareholders. Or they can just start leave those two things constant and start repurchasing common stock with excess cash flow that might have been built up over time, and that'll pay down the amount in retained earnings, and therefore bring the capital stack into alignment with the optimal capital structure. A repurchase can be used to minimize dilution associated with existing exercising stock options by management. So you essentially buy stock on the open market, and that keeps everybody essentially as a percentage whole. Stockholders don't have to sell their shares to the company during a repurchase period. So it provides an option, not a technical option, but a economic option to the shareholders to go, hey, I want to sell my stock or not, but there's no mandatory. They also don't have, if they want the dividend, so to speak, they can sell some of their shares. And many investors believe that a stock repurchase program is a signal from management the firm's stock is undervalued. And so there's the best use of that excess capital. If they can't find a good opportunity in the market, to expand the firm itself has essentially more opportunity than is a good investment. And so we're going to utilize our excess cash and concentrate more earnings and buy the stock in the open market, and it's a bargain to purchase. There's some disadvantages as well. The company might pay too much for stock that's repurchased, so they might be we're going to repurchase X dollars every quarter, regardless of what the stock price is, and they might be overpaying. The interval between one stock repurchase and another is generally irregular, which means investors can't rely on the cash that they receive from stock repurchases. They may have to just sell into the open market. And so sometimes the repurchase can be done directly with the company. Normally now companies are exercising these on the open market. But what that will also do is create additional demand for the stock during that period of time. Price might go up and then it'll slide back down when the demand lifts from the repurchase program. Again, when we look internationally, depending on the both culture and tax structure, you will see, for instance, companies in Italy and Japan have a lot of debt. U.S. and Canada tend to be about very similar, and the U.K. uses less debt than pretty much anybody in the world. Different accounting practices make comparisons difficult, although for those of you who are accounting scholars, there's a accounting standard called IFRS, International Financial Accounting Standards or Regulations, and GAAP is moving toward IFRS, as are other international accounting standards, and pretty soon, they're getting more and more similar, and the gap has narrowed in recent years. But different accounting practices make comparisons difficult, and dividend payout ratios vary greatly, and a lot of that depends on, again, combination of culture and tax. The tax code generally favor the use of debt in developed countries. In countries where capital gains are not taxed, investors should show, and generally do show, a preference for stock compared to countries that have capital gains taxes. And yes, capital gains taxes aren't always out there. And investor preferences should lead to relatively low equity capital costs in countries that don't tax capital gains. And then you've got risk. So what about bankruptcy costs? So foreign banks are closely linked to corporations that borrow from them. We talked about this earlier in the course. You've got like Mitsubishi Manufacturing, which also has a bank attached to it, so that they have significant influence over the management of the debtor firms and can regulate some of those things without the government's involvement. Equity monitoring costs are relatively low in companies like the U.S. Because there's a lot of required filings with the Securities and Exchange Commission. So as a result, U.S. firms have more equity and less debt than firms in countries like Japan and Germany, where they're much less transparent. And so as a result, they tend to have to borrow additional debt in order to be able to get the capital that they need in order to function. So again, this is the view of capital structure. And we'll try and tie everything together at a policy level in the next section of the course.